Imagine you have $500 sitting in your bank account, and you finally decided that it's time to start investing. You open your brokerage app, ready to make your first investment. But suddenly, you're faced with hundreds of different funds. You open your brokerage app, ready to make your first investment. But suddenly, you're faced with hundreds of different funds. And now you're holding your $500, wondering one simple question: where should this money actually go? Don't worry. In the next few minutes, I'll break down these different types of funds and show you what actually matters when choosing one. Let's start with the simplest question. What exactly is an investment fund? Imagine 10 people, each with $100 to invest. Instead of everyone investing separately, all 10 people decide to put their money together into one large pool. Now that pool contains $1,000, giving the group much more money to invest than any individual person had alone. The fund can use that money to buy many different investments, such as stocks, bonds, or other assets. And because everyone owns a small part of the fund, each investor gets exposure to a much larger portfolio without buying every investment individually. Why does that matter? Imagine putting all your money into one single investment. If that investment suddenly loses a huge amount of value, your entire portfolio could take a serious hit. But when your money is spread across dozens or even hundreds of investments, one bad performer doesn't necessarily destroy everything. That's diversification. Now let's look at one of the simplest approaches, the index fund. One famous example for American investors is the S&P 500, which tracks a broad group of major U.S. companies. You could spend hours researching hundreds of companies, reading financial reports, comparing profits, and trying to figure out which company will become the next big winner. Or you could take a completely different approach. Instead of trying to pick the winner, simply invest in a broad group of companies. Or you could take a completely different approach. Instead of trying to pick the winner, simply invest in a broad group of companies. Think about trying to predict which company will dominate the next decade. Even professional investors can get that prediction wrong. An index fund takes a simpler approach. Instead of saying, "I know which company will win," it says, "I'll own a broad part of the market." That's why passive investing can feel almost boring. You aren't constantly buying and selling stocks or trying to predict tomorrow's winner. It's more like putting your investments on autopilot and following a predefined strategy. Rather than spending every night researching individual companies, you're following a broad market strategy designed for the long term. This means fewer decisions and a simpler approach to investing. Another major advantage is cost. Because index funds usually require less active decision-making, many can operate with very low expenses. That means more of your potential return stays invested instead of going toward fees. And don't underestimate those fees. A small difference in annual expenses can become a surprisingly large difference when your money stays invested for several decades. Over time, even tiny percentages can compound into real money. That's one reason Warren Buffett has repeatedly recommended low-cost S&P 500 index funds as a simple option for many ordinary investors. The idea is to keep investing simple rather than constantly trying to predict which stock will win. But now, let's meet another type of investment vehicle, the mutual fund. And this is where things start getting confusing, because mutual funds and index funds aren't necessarily completely different things. A mutual fund isn't automatically an actively managed fund. The term mainly describes a structure for pooling investors' money. A mutual fund can actually be actively managed or designed to track an index. That fund can be actively managed, meaning a professional manager decides which investments to buy, sell, or hold. The manager studies companies and market conditions before making those decisions. Think of the manager like a professional chef. Instead of following a fixed recipe, the chef carefully chooses different ingredients for the portfolio, hoping those choices will produce better results. But just like a professional chef doesn't work for free, professional investment management comes with costs. You're paying for the people, research, analysis, and work involved in managing the portfolio. Those costs can include management expenses, research, trading, and other fees. And over time, higher costs can reduce the return that actually reaches you, especially when you're investing for many years. The manager's goal is usually to outperform a benchmark, such as the S&P 500. Imagine the manager literally racing against the market, trying to finish ahead after all those additional costs. And here's the problem. Consistently beating the market is extremely difficult, especially after accounting for fees and expenses. The manager has to outperform the benchmark enough to make those extra costs worthwhile. Some managers perform extremely well, others don't, and even a manager with an impressive track record can struggle when market conditions change. Past performance alone isn't a guarantee of future success. So don't just ask, did this fund make money? Ask whether its performance was worth the additional risk and fees. A higher return isn't necessarily better if you had to take much more risk to achieve it. Now let's talk about ETFs. ETF stands for Exchange Traded Fund, and they're one of the most popular ways to invest today. They combine a pooled portfolio with the ability to trade shares on an exchange. An ETF can hold a diversified collection of investments, and you can buy or sell its shares through a brokerage account. So one purchase can give you exposure to many different investments at once. The important part is that an ETF trades on a stock exchange, just like an individual stock. That means investors can buy and sell ETF shares during normal market hours. That means its market price can move throughout the trading day as buyers and sellers trade the ETF. The price you see on your screen can change continuously as market conditions change. This is different from a traditional mutual fund, which is generally bought or sold at a price calculated once at the end of the trading day. So you don't continuously trade a traditional mutual fund at changing market prices. So think of an ETF as a basket of investments that you can trade throughout the day, while a mutual fund uses a different buying and selling structure. Both can provide diversification, but the way you buy and sell them is different. And here's the part that confuses almost everyone. An ETF and an index fund aren't actually opposites. They're describing two different things, which means they can overlap. An ETF can be an index fund. For example, an ETF can simply track an index like the S&P 500, giving investors broad exposure to the market through one easily traded fund. But not every ETF is an index fund. Some ETFs are actively managed, so don't judge a fund simply because it has ETF in its name. Always check what strategy it actually follows. Before buying any ETF, check what it owns, what it charges, what strategy it follows, and how much risk you're taking. The name alone doesn't tell you the whole story. And then we have hedge funds. This is a very different world from the simple index fund most beginners hear about. Hedge funds can use sophisticated strategies and are often managed by professional investment teams with much more flexibility. Their goal may be to generate returns using strategies that ordinary funds don't normally use. For example, some hedge funds use short selling, allowing them to potentially profit when certain investments fall in value. Instead of only betting that prices will rise, they can sometimes position themselves for a decline. They may also use leverage, meaning they can increase the size of an investment position using borrowed money or financial instruments. This can make both potential gains and potential losses much larger. But leverage is a double-edged sword. It can magnify gains when you're right, but it can also magnify losses when you're wrong. A relatively small market move can become a much bigger financial result. That's why higher potential returns usually come with higher risks. A strategy that looks exciting on the way up can become painful very quickly during a market decline, especially when leverage is involved. Hedge funds can also have more complicated structures, restrictions, and investor requirements. So they're usually not where a beginner should start. For most new investors, simpler options are easier to understand and manage. And then there are the fees. Hedge funds have historically been associated with the famous 2 and 20 model, although actual fees vary from fund to fund. The important point is that sophisticated strategies can come with significant costs. So let's return to where we started. You have $500, and now you understand the major differences between these types of funds. So which one actually makes sense for you? If your priority is simplicity, broad diversification, and keeping costs low, a broad, low-cost index fund can be a reasonable starting point for a long-term investor. If you prefer the flexibility of trading throughout the day, an ETF may be more attractive, especially if it provides broad diversification at a low cost. If you want active management, carefully examine the fund's strategy, performance, fees, holdings, and risks before putting your money into it. Don't assume that paying more automatically means getting better results. And don't choose an investment simply because it produced an incredible return last year. A flashy investment can look very different when market conditions change, and yesterday's winner isn't automatically tomorrow's winner. Think long-term. Investing is less about finding the hottest investment today and more about building a strategy you can stick with for many years, including during periods when markets become stressful. The most important question isn't which fund is the best, it's do I understand what I own, what it costs, how it works, and what could go wrong? Because you don't need to understand every investment in the market. You just need to understand the investment you choose and why it fits your goals. If this video helped, like and subscribe, and I'll see you in the next one. Thanks for watching. If you found this video helpful, don't forget to like, subscribe, and turn on notifications for more simple and practical investing lessons. See you in the next video.